This was supposed to be about CPI numbers, PCE numbers, jobs data. There's going to be a bigger discussion at the table when we get there on Tuesday. Do you think that what we've seen over the past week and a half is going to be enough to change the trajectory of what they've been doing?
So we haven't changed our forecast with everything that's going on. And clearly there are a lot of evolving factors here. But we still think the Fed is going to go 25 basis points next week. If you look at the inflation data from yesterday, they still have an inflation fight ahead of them. We got 0.5 on core, 0.5 on that super core measure, right? That core services excluding rents. So there is an underlying persistence in inflation right now, and the Fed is not done yet.
When you look at the economic data yourself and make your own assessment, do you think our economy is strong enough or resilient enough to withstand additional hikes?
Yeah, I think so. I think this is a slow-moving process. I mean, you see the retail sales data today. There is a lot of strength still, within a lot of sectors of the economy. Our forecast has also been pretty consistent for growth. We've been seeing this as a slow-moving process, and we still think we are headed for recession at some point later this year. That hasn't changed. We'll have to see what happens with the banking sector and systemic risks. But if this leads to tighter lending standards, reduced credit creation, our economists just put out a note this afternoon estimating that could actually shave about a half to a full percentage point off GDP growth for the next year or two.
Well, that's what I'm curious about here, because there is some concern that is where we're headed. It may not be a complete cutoff of financing the way we saw during the big financial crisis, but the idea that it will be so costly for certain companies, certain people, that they just won't borrow, and of course they won't spend.
Yeah, I think we're in a very different economy now than we were, after the financial crisis. So we'll have to see what the spillovers are. Among large U.S. banks, capital and liquidity is still very strong. So the real question is, what will the, spillover be for hiring and spending among consumers? If hiring remains in a lot of sectors of the economy where we have seen labor shortages, wage inflation is going to be slowed to come down. And if we don't see that, then core services inflation, again, stays elevated. So the Fed, if they back off too soon, they risk, losing that credibility in their commitment to fighting inflation.
Absolutely. And of course, we know there is always a big difference in market reaction between the Fed's statement and, of course, the press conference. I think more people this time around are going to be much more focused on what Powell has to say. And I am curious. We talk about this being kind of the anniversary tomorrow of the rate hiking cycle officially starting, but we kind of forget that he was jawboning the market for months prior to that these rate hikes are coming here. What can he say next Wednesday that would, I think, provide more confidence that the banking system is sound, that the Fed is doing the right thing, and that we're all not going to lose our jobs and be out in the street?
Yeah, I mean, I think that he, needs to be moving slowly here, watching the data and be forward-looking. I think we were surprised at his commentary last week that suggested he could maybe reaccelerate to 50 basis point hikes. That seemed difficult to sort of square in our eyes. I think moving at a gradual 25 basis point hike, and also, assuring markets we are monitoring what's going on in the banking system right now. We're ready to respond is sort of all he can do. I think, it's interesting. The Fed has a difficult challenge of having to provide forward guidance and the dot plot, and it's going to be interesting to see what shows up there. I think we could see a broader range of views.